Welcome to this short review session on financing a trade. Before we start, let us briefly talk about the word financing. In everyday life, financing usually means borrowing money to buy something expensive, like a car or a house. The lender provides the money, earns interest, and takes the risk that the borrower may not repay the loan. In securities markets, financing is a bit different. Every securities transaction has two sides, the buyer of the security and the seller of the security. The buyer will receive the security and pay cash. If the buyer does not have the cash, the buyer may need to borrow it. Helping market participants borrow cash is one function of the securities financing market. The seller, on the other hand, must deliver the security at settlement. If the seller does not own the security, it may need to borrow it. Helping market participants borrow securities is another function of the securities financing market. Securities financing markets therefore help market participants borrow what they need to settle and maintain their positions: cash or securities. Securities financing markets are professional markets between institutional counterparties such as banks, broker-dealers, traders, and hedge funds. Professional market participants try to reduce counterparty risk whenever possible. As a result, securities financing transactions are usually collateralized. This means that the trader who borrows cash to buy a security has to post collateral to the cash lender. In many cases, the trader buying a security will therefore just post that same security as collateral to finance the trade. Let me pause here for a second to highlight the symmetry of a securities financing transaction. Economically, you can think of the trader as borrowing cash and lending the security. Similarly, you can think of the cash lender as lending cash and borrowing the security. Also notice that the trader will eventually get the security back once the financing transaction ends. As a result, the trader keeps the economic exposure to the security. This is an important difference between lending a security and selling a security. When you sell a security you own, you give up the economic exposure. When you lend out a security you own, you keep the economic exposure. So far, we have only looked at the trader borrowing cash. Of course, the same principle also applies to the trader borrowing a security. He also will have to post collateral. The trader could use cash as collateral, but since traders are often short on cash, they may prefer to use another security as collateral. In general, collateral is a scarce resource for traders, and collateral management is therefore an important task. Traders often use whatever securities are available in their trading portfolio as collateral. So far, we have discussed the economic purpose of securities financing markets. Let us now look at the main structures used in practice. There are three important forms of securities financing: repo transactions, securities borrowing and lending transactions, and margin financing. Repo transactions are mainly used to borrow cash against securities as collateral. They are widely used in money markets and fixed income markets. Securities borrowing and lending transactions are mainly used to borrow securities against collateral. They are particularly common in equity markets, where traders often need to borrow securities for short selling and market-making activities. Margin financing serves a similar economic purpose, but usually takes place between a broker and its client within an ongoing financing relationship. The terms of that relationship are typically governed by a collateral agreement between the client and the broker. We will mainly focus on repo and SBL transactions, because they are the core building blocks of professional securities financing markets. Let us now look at a repo transaction in more detail. Legally, the transaction is structured as a sale of the securities combined with an agreement to repurchase them later. That is why the transaction is called a repurchase agreement or repo. It also explains why the party borrowing the cash is referred to as the seller. But economically, the seller is just borrowing money, while the securities serve as collateral for the lender. If we look at the transaction in more detail, the repo transaction consists of two opposite legs: the purchase transaction and the repurchase transaction. On the purchase date, the seller delivers securities and receives cash. At the repurchase date, the transaction is reversed. The seller repays the cash together with the repo interest, and the buyer returns the securities. Because the buyer receives securities as collateral, the buyer faces very little counterparty risk. As a result, repo rates are usually lower than unsecured money market interest rates. Note again that because the securities are returned at the repurchase date, the seller keeps the economic exposure to the securities throughout the transaction. Let us now turn to securities borrowing and lending transactions, often called SBL transactions. While repo transactions are mainly used to borrow cash, SBL transactions are mainly used to borrow securities against collateral in the form of other securities or cash. In this market, the party borrowing the security is referred to as the borrower. Similar to a repo transaction, legal ownership of the securities is transferred to the borrower during the SBL transaction. The SBL transaction has two dates: the start date and the return date. On the start date, the lender delivers the securities and receives collateral. At the return date, the transaction is reversed. The borrower returns the securities and the lender returns the collateral. The borrower also pays a fee to the lender. This fee is what the lender earns for lending the security and is called the securities lending fee. Note that because the securities are returned at the end of the transaction, the lender keeps the economic exposure to the security throughout the transaction. So far, we have assumed that the value of the collateral exactly matches the value of the cash or securities being borrowed. In practice, though, lenders usually require collateral worth slightly more than the exposure. This additional collateral protects the lender against market price movements and other risks in case the counterparty defaults. Different securities financing markets use different terminology for this additional protection. In repo markets, the lender usually lends slightly less cash than the market value of the collateral securities. This difference is called the haircut. In securities borrowing and lending markets, the borrower usually posts collateral worth slightly more than the value of the borrowed securities. This is called over-collateralization or margin. Economically, however, these concepts are very similar. In both cases, the lender receives additional protection against counterparty risk. Finally, I would like to reiterate the symmetry in professional securities markets, not only when it comes to borrowing and lending, but also when it comes to buying and selling. People are often surprised when they first hear about short selling a security. Short selling means selling a security that you do not own. You can do that, is a common reaction. In most jurisdictions, selling a security you do not own is legal, provided that you deliver the security at settlement, which is typically 2 business days after the trade date. If the seller does not own the security, the seller has to borrow it before settlement. And where can the seller borrow the security? In the securities borrowing and lending market, of course. Conceptually, selling a security you do not own is not very different from buying a security without already having the cash to pay for it. In everyday life, we are used to borrowing money. As a result, buying something without having the cash available feels natural to most people. Borrowing a security before selling it, however, feels less intuitive. But in professional securities markets, borrowing and short selling securities is a normal market practice. Thank you for listening, have a great day, and I look forward to seeing you in the next review session.